Okay, so these are your review terms. I would assume that you would know by now: raw material, direct labor, manufacturing overhead, work in process, finished goods, cost of goods manufactured, as well as cost of goods sold, which we've covered. So we'll start here. Okay, so this shows you that direct material, direct labor, and manufacturing overhead can be applied to the individual jobs. So direct material and direct labor are applied to the individual jobs as they occur, and then the manufacturing overhead jobs, or the manufacturing overhead, is applied at the end of the period, as shown here. Okay, so So obviously you know now how to estimate the predetermined overhead rate. That's the POHR that you see right here. And it is always divided by the cost driver, which you will always be provided. It's typically direct labor or manufacturing overhead. So you'll take the total estimated manufacturing costs, those will also be given to you, and divide that by your cost driver, whatever your cost driver is that they tell you. That includes both the fixed and the variable portions of the estimated overhead. Okay, so this is where life gets kind of fun. So the idea here is that the material purchases, the direct labor, and manufacturing overhead all go into this account called work in process. These are all inventory accounts found on the balance sheet, but the purchases, you can see the labor and the manufacturing overhead go into this work in process as they're being processed. And then, of course, once they are finished, they moved into another balance sheet inventory account called finished goods. Once they are sold, they move on to the cost of goods sold for those items that are sold. So this is just a general flow of how the costs work. I think that's important for you. All right, so you can see that as things are incurred, then they move. So a material purchase comes into raw materials, but then as it gets used, any of the indirect portion of the raw materials would go into a manufacturing overhead applied or actual account. Now, one thing I want you to notice here is that under manufacturing overhead, I usually create a T account. I like this as an example because the actual manufacturing overhead, right, those things that are actually incurred go on the left-hand side. Those manufacturing overhead items that are applied once the jobs are complete appear on here. So that's going to be really important for you to keep straight in your head as you go to figure out what is over-applied versus under-applied manufacturing overhead, and you'll see that. Okay, so next slide. So here you can see that the direct materials will go directly into the work in process, whereas those indirect materials, screws, glue, what have you, go into the manufacturing overhead. Okay, this is all going to make sense to you. Okay, same thing with wages, right? So the direct wages, like the factory workers and that type of thing, that direct labor will go into that same work in process account, whereas the indirect labor will go in, do you see that, under the manufacturing overhead right here? Okay. And then you can see as manufacturing overhead gets applied, the amount based on the predetermined overhead rate is a credit, which goes as a debit into the work in process account. Okay? So, and as I mentioned before, as a job is completed, it goes from the work in process account, which included, based on the previous entries, the direct material, direct labor, plus that amount of manufacturing overhead that was applied based on the cost driver and the estimated manufacturing overhead. Okay, it becomes a credit, so that amount for that job becomes a credit and moves over to the finished goods as it gets finished. And that kind of makes sense if you think about it. A car that's being manufactured is either in process or it's done. So once it's done, then it moves from being in process to being done. Okay, so this is kind of the overview. Once it goes into process, all of those things that go into making the car, for example, would go from, go into the work in process. Once they're completed, they come out as a cost of goods manufactured into the finished goods. Once they are sold, they move out of finished goods into the cost of goods sold. So I particularly like this slide because it overviews all of that. Provide you a little bit more detail on the cost of goods manufactured. I just wanted to, that's kind of this piece right here, is I'm going to take you through and actually walk you through how you get this cost of goods manufactured based on these items here. So the sum of all the amounts transferred from the work in process, to the finished goods represents the cost of the goods of the manufacturer. Now let's break that down. What does that mean? It's the cost of the goods that I just manufactured. It's as easy as that. So let's go ahead and take one deep look into this. So I start with my raw materials. Why do I start with raw materials? Because do you see these direct materials right here? How did they get into work in process? That's the main question. So I start with whatever I had in my raw materials. Let's think of like a closet where we put all of our skateboard wheels or whatever, and then we buy more. So then we've got the stuff that we had to begin with, the beginning, plus the things that we purchased, and that's all the possible raw materials that we have that we could produce. Then when we look in this closet afterwards, then we're going to see that we actually have some raw materials left over. In other words, we assume that we didn't use every possible thing that we had in our raw materials. So whatever is not there still at the end is what we've used in production. So you got to think about this. Okay, I had some wheels in my closet, then I added some more. Let's say I had 8 wheels because there's 4 per skateboard. Okay, 8 wheels. All right, and then I added 8 more. Now I've got 16 raw materials available for production. If I use 8 of them, right, or if I have 8 left over, then I've got 8 that I must have used in production because they're not there anymore, right? Okay, so then those become the direct materials. So let's go back. I hope this doesn't bug you, but here is that's where I got this direct materials number right there. Notice one small detail here is that when I'm talking about the materials before they've been used into the production, they're called quote unquote raw materials. You notice that this raw material changes its name magically when it becomes part of the production process. It's no longer a raw material, it's now direct materials. Okay, it's just a subtle difference there. Okay, so then let's build on our manufacturing. Okay, so then we've got our direct materials, our direct labor, and our manufacturing overhead applied. And that gives us our total manufacturing costs. Oops, sorry. And then, I went too fast. Then when I look at my, so far so good, right? Because we've got, these are all of the things that are going into it. These are just the manufacturing costs. This doesn't mean that that's everything that we've completed. That just means everything that got thrown into the pot that we're actually going to, that we're in the process of manufacturing. So then that's the key, in process. So now we're going to look at our work in process account, and we're going to say, well, at the beginning of February, for example, we had XYZ products that were still in process. They weren't finished, otherwise they would have been in finished goods. They are somewhere in the, in the process of being finished. Maybe they just need their stickers put on or whatever. So I've got my beginning work in process plus what I've added. Remember, these things got added to the work in process. And that's the whole stuff that I've got that I'm processing that period. Then I take a look and I go, well, what haven't I finished? That's the ending work in process, because it's one of two places. It's either still in process or it's in finished goods. Okay, so I'm basically saying, what's all the stuff that I started with, then what stuff I've added to it, and then what's still there at the end of the period,
and the balance is the actual cost of goods manufactured. So this is a particularly good slide because it really shows you the entire flow of everything. Then once we have that cost of goods manufactured, this is just a repeat of that previous slide on the right hand side, then we look at our beginning finished goods inventory. So what did we already have? How many skateboards did we have that were done, they were just waiting to be sold? And then check this out, these also were finished, otherwise they'd still be work in process, but they're not, they're finished. So they're finished. So I had 10 skateboards at the beginning of the month that were ready to sell. I have 6 more than I manufactured. So now I had, what did I say, 10? 10%. So I got 16 available for sale. Then I look at the end of the month and I've only got 4 left, so I must have sold 12 of them. Okay, that's just an idea, but that's the entire process flow. And then I put in the PowerPoint slides, not in this little explanation, I've put in some quick checks. So make sure that you go through all the PowerPoints and look at the very end, and I've given you some quick checks just so you can find out. And of course you get the answer at the end with an explanation so you can see if you're on the right path. You don't have to do these, I'll never know, but sometimes it's nice to be able to check your understanding. Okay, hope that helps.
Okay, continuing on, sorry, this is in 2 parts. The next thing that's going to happen is we're going to look at either over-applied or under-applied manufacturing overhead, depending on where the balance is in the manufacturing overhead account. So you can see that in this first example, there was $680,000 that was actual that came in as manufacturing overhead. Of course, on previous slides, you know that this consists of indirect material, indirect labor, and other random manufacturing overhead. All right, that was all totaled up. And at the end of the month, it totaled, I just gave you some figures here, $680,000. But the amount that was applied based on the overhead, the predetermined overhead rate times how much was actually used. Say if it was based on machine hours, then this was based on the predetermined overhead rate times the actual amount of hours, and so that's how the applied came about. You can see that these two numbers are not the same. There's more over here, which means there's a balance in the actual overhead, and you can just see here that there's less here, more here, so more needs to be applied, right? You get that? Okay, let's look at this example. In this case, the numbers are switched, and there was actually only $650,000 in costs that were actually incurred under manufacturing overhead. But there was $680,000 that was applied, so you can see just by your very own eyes that there's actually too much that was applied. So it was what we call over-applied. All right, so now what do we do with that $30,000? It can either be, whether it's under-applied or over-applied, it can be allocated to the different accounts where it originated from, which was work in process, cost of goods sold, and finished goods, or it can be closed out directly to the cost of goods sold. If you think about it, the origination of the cost of goods sold was from the finished goods. Where finished goods came from was the work in process. So this basically distributes it over all of them, or it just closes it out directly to the work in process. In the case where the overhead was over applied, meaning that we had applied too much manufacturing overhead, we're simply going to adjust that by taking it out of the cost of goods sold. So here we're going to take that out of the cost of goods sold. I think this is an important slide because you can see that if manufacturing overhead was under-applied, meaning that applied overhead is less than actual over-applied, we need to apply more overhead, then we can simply increase the cost of goods sold, which inevitably will reduce net income, right? More expenses, less net income. On the other hand, if the manufacturing overhead was over-applied, that means we incurred too many expenses. Cost of goods sold is an expense. So we're going to decrease the amount of cost of goods sold, which will increase the net income. And this is really the one that I want you to focus on. This just shows you that I had a certain amount of unadjusted cost of goods sold. Then I take into account either my under-applied or overhead